Hey everyone, and welcome back. We're diving into something that's been kind of unavoidable lately. I mean, it's everywhere you look, the R word.
Yeah, the big one, recession. Definitely been getting a lot of questions about this.
For sure. And we've got a ton of articles and research you guys have sent in on this topic. So today, we're going to sift through it all, figure out what's what and what it means for you, practically speaking.
Absolutely. And we're going way beyond just like the headlines and the doom and gloom. We'll be digging into those economic signals, looking at historical patterns, even some of those kind of curious indicators, the things that tend to pop up when things are shifting.
Because, and I think we can all relate to this, just hearing that word recession can cause like a mini freak out.
Definitely.
But before we spiral, let's start basic. What actually is a recession? Like officially, is it just like a feeling, bad vibes in the economy?
Officially, yeah, it's 2 quarters in a row of that GDP, that gross domestic product, shrinking. Basically, the economy getting smaller for 6 months straight. Textbook definition.
Okay, so 2 quarters shrinking.
But, and this is a big but, it's never as simple as just one number. There's always more to it.
Right. And that's what makes this whole thing so tricky. Because I'm seeing articles out there. Some are like, we're already in a recession. And then others are saying, hold your horses, not so fast. So which is it? Where do we even start with this?
The $1 million question, right? Well, one place to start might be this thing called the SAM rule. This economist, Claudia Sam, she came up with it. It's basically an early warning system for recessions.
Okay, an early warning system. So how accurate is this thing?
Scary accurate, actually. It's predicted every recession since the 70s, so it's got a pretty good track record. It looks at how fast unemployment changes. If it jumps up a certain amount in a short period of time, alarm bells start going off.
Okay, got it. So unemployment jumps up quickly.
And guess what? The July numbers, they just tripped that alarm.
Oh, okay. So based on this SAM rule alone, we're headed into a recession right now. Is that what you're saying?
That's one way to look at it. And it's not just this rule. Deutsche Bank, big global finance people, they're waving a big warning flag too, talking about how we might need, get this, a deep recession to really tackle inflation.
Deep recession. Okay, so not exactly the news anyone wants to hear, but you mentioned there are other perspectives on this too, right? It's not like everyone is jumping on this recession train just yet.
Nope, not at all. There's a counter-argument that this whole economic situation is just different. You can't really compare it directly to the 2008 mess or even 2020 with the pandemic. Trying to draw lines straight from the past might not be giving us the full picture.
So what makes this time so different? Is this like the pandemic hangover or something?
Could be part of it, yeah. Some experts think that the SAM rule itself, it might be thrown off by all the weird stuff that happened after the pandemic. Like, think about it. You had this huge surge in immigration, people flooding back into the workforce who were out of it before. All that shakes things up, messes with the unemployment numbers, even if the economy isn't actually shrinking.
So it's almost like a delayed reaction, like the numbers are playing catch up.
Yeah.
But it doesn't necessarily mean the economy is doing badly right now.
Exactly. And adding to that, the IMF, the International Monetary Fund, they've said that the U.S. economy, it might be tougher than it looks, pointing to stuff like, consumer spending still being strong. So, people are still out there buying things.
So it's kind of a mixed bag right now. We've got some signals flashing red, but then others are a bit more optimistic, I guess.
Right. It's like everyone's holding their breath a little to see which way it's going to swing.
Yeah, totally. So we've got this whole are we, aren't we recession thing going on. But then I'm hearing about this other term, silent depression. Is that a real thing?
It is. It's a way to describe this situation where even without the classic big obvious recession signs, tons of people losing their jobs, stock market crashing, there's just this feeling, this widespread feeling that things are off.
And I feel like a lot of people, they just viscerally get that, even if they've never heard that term silent depression before.
Right.
It's that thing of maybe holding back on bigger purchases or putting off life plans because you just don't know what's coming next, even if technically you're doing okay financially.
Exactly. And one of the things that's feeding into this whole silent depression thing, it's how businesses have been acting ever since that 2008 crash. It's like they're still traumatized.
Still carrying those scars, huh?
Big time. So even when the economy is doing well, growing, a lot of businesses, they're hesitant to do big hiring sprees or really invest. They're playing it super safe.
Keeping their powder dry.
Yeah.
Just in case everything goes south again.
Yep. And it's called labor hoarding, which sounds better than it actually might be. On the surface, keeping people employed is good, right?
Sure.
But it could also mean that those companies, they're running on fumes. thinner margins than they let on. So if there's even a little dip, a little wobble in the economy, those jobs that seemed safe, suddenly they're not.
Like a house of cards. Looks stable, but the tiniest shake could bring the whole thing down.
Exactly, a perfect way to put it. And all this feeling of uncertainty, it's not just in our heads, it shows up in some pretty concrete ways too. And that's where we get into these weird economic indicators.
This is where it gets interesting. The stuff that's not like official government data, but still tells you something about how people are actually feeling, how they're behaving when they think no one's watching.
Exactly. And some of them are pretty wild, if a little morbid.
Oh, I love a good morbid fun fact. Hit me with it. What kind of indicators are we talking here?
Well, there's the unclaimed corpse index.
Okay, that took a turn. But all right, listening. Unclaimed corpse index. What is that?
So it sounds grim, and it kind of is, but it's a real thing. When the economy really tanks, especially in those really bad downturns, you tend to see more bodies left unclaimed at morgues.
Wow, okay. Yeah, that got dark fast.
Yeah.
But I see what you're saying. It's like people can't even afford funeral expenses.
Yeah. Sadly, yeah. It's one of those indicators that nobody wants to talk about, but it's a real sign of just how tough things are, especially for, for people who are already struggling. There was a really stark example of this back in 2008. Wayne County Morgue. This is in Detroit. City was hit hard by that recession. They had a record number of bodies that were just nobody claimed them.
Yeah, that's really rough. And it makes you think about, when money gets tight, people have to make really hard choices about what they can and can't afford, what they're going to cut back on.
Yeah, absolutely. And those cutbacks, they can show up in some pretty unexpected ways. Ever heard of the lipstick index?
Vaguely. It rings a bell. Something to do with women buying more lipstick during recessions.
That's the one. This guy, Leonard Lauder, Estee Lauder, the cosmetics company, he's the one who came up with it. He noticed that whenever the economy would take a dip, lipstick sales would actually go up, even when other stuff, more expensive stuff, wasn't selling.
Interesting. So people were still buying lipstick even when they were cutting back on other things.
Right. And his theory was it's psychological. Even when times are tough, people still want a little something to treat themselves, feel good. And lipstick, it's relatively cheap, right? It's that little touch of luxury. It can boost your mood, but it doesn't break the bank.
I can see that. It's like a little act of defiance against all the doom and gloom.
Yeah.
So we've got unclaimed corpses, we've got lipstick, and then you mentioned mosquitoes earlier.
Yeah.
What's the deal with mosquitoes and the economy?
All right, so this one is a little out there, but it's kind of fascinating. So back in 2008, again, a bunch of places saw this weird trend. Way more calls for mosquito control than usual.
Okay.
And it turned out a lot of these calls, they were coming from areas with a ton of foreclosures, like neighborhoods that had been really hit hard by the housing crisis.
Mm-hmm.
See, when people lose their homes or they just can't afford to keep them up anymore.
So properties fall apart.
Yeah, and those neglected backyards, they become breeding grounds for mosquitoes. So more mosquitoes.
Mm-hmm.
Could actually be a sign of a struggling economy.
That's wild. It's like this weird indirect indicator. Who knew? So, okay. Unclaimed corpses, lipstick sales, mosquito infestations, anything else? Should I be watching for swarms of locusts or something?
Shuckles? Maybe not locusts, but there's another one that gets talked about a lot, the stripper index.
The stripper index. Okay, now I have to know. How does that one work?
So the basic idea is when the economy's doing well, people have more disposable income, right? They're spending money on everything, including things like strip clubs.
Okay, so more money flowing, more money for entertainment, I guess.
Exactly. But then when the economy starts to slow down, that discretionary spending, it's one of the first things to go. Fewer people going out, fewer dollar bills raining down on those stages.
So fewer dollar bills equals a downturn in the economy. That's the stripper index.
Basically, if strippers are suddenly making way less money, it could be a sign that things are about to get rough out there in the wider economy.
Okay, that is both fascinating and kind of depressing at the same time. All right, so we've got all these anecdotal clues, these whispers in the wind, maybe suggesting a recession is on the way. But I'm guessing none of these weird indicators are foolproof, right?
Definitely not. They're interesting, for sure. But you wouldn't want to base all your financial decisions on lipstick and mosquitoes. They're more like conversation starters. Things to keep in mind, as part of the bigger picture.
Yeah, okay, that makes sense. So if we want something a little more, a little more statistically sound, what should we be paying attention to? You mentioned this thing earlier, the 10-2 bond yield spread. That sounds pretty official. Definitely not something you'd chat about at the strip club unless maybe it's economist night or something. What is that exactly? And how does it relate to all this recession talk?
Yeah, you're right. Not exactly light conversation, but it's one of those things economists watch really closely. So basically, it measures the difference between the interest rates on two different kinds of U.S. government bonds. It's kind of like investors buy these bonds, and that's like loaning the government money.
Okay, so you're loaning the government money, but where does the spread come in? And how does that tell us anything about a recession?
So the spread is the difference between the interest rates those bonds are paying. When investors are feeling good about the future, they think the economy is going to be strong, they're cool with accepting a lower return on those longer-term bonds, the 10-year ones.
Because they figure the economy is going to be humming along anyway, so why not lock in their money for longer?
Exactly. But if investors get nervous, they're like, uh-oh, recession's coming, they get way more cautious about those longer-term bets.
So they pull back, put their money into those shorter-term bonds instead, those 2-year ones.
Yeah.
Which is why the yield on those goes up.
Exactly. And when that happens, that's when that spread narrows, and sometimes it can even invert.
Invert, meaning?
Meaning the interest rate on those short-term bonds, it's actually higher than the long-term ones.
And that's bad, economically speaking.
It can be a really bad sign, historically, a negative or inverted yield curve. It's predicted every single recession we've had since, get this, 1976.
Wow, okay, so it's not just some random thing then.
Nope. It's like the whole market, all those investors, they're voting with their money. And right now, that spread, it's negative.
Okay, small interruption here for quite a big disclaimer. First, what NotebookLM's podcaster Sophie just said was generally true at the time of the podcast writing, the 23rd of October, 2024, and it kind of still is. The yields of U.S. government bonds are bigger for the short period bonds than the bonds of the bigger timeframes. So most spreads between yield curves of smaller timeframes versus bigger timeframes are negative, thus inverted. For example, 10-year minus either 1 month, 2 month, 3 up to 6 month bond are still negative. As of November 1st, the yields in line starting from 1 month go downwards to smaller yields, with the smallest being the 3-year, and then the yield starts being bigger. Secondly, with these said, the most important of the spreads, the 10-year minus 2-year, has reverted back to positive, thus the inversion has ended, which is a recession signal. Thirdly and last, all spreads have started climbing significantly, and soon both 10-year minus 3 months and minus 6 months will end their inversion. Back to the podcast.
Interesting. So not a guaranteed recession, but definitely something to keep an eye on.
Absolutely.
Okay, so much to think about there with the bond market and everything. I want to loop back to something we touched on earlier, though. All those bleep jobs, how do they play into this whole recession picture?
Yes, those bleep jobs. Or as this anthropologist David Graeber called them, and it's a much better term, bullshit jobs. Basically, those jobs that even the person doing them can't really explain why they exist.
We've all had them, right? Those jobs that just feel unnecessary.
Yeah.
But what's the link between bullshit jobs and like an actual recession?
Well, think about it. When interest rates are low, when money's easy to come by, companies, they can get away with a little more bloat.
Okay.
They create these jobs, often in places like, the tech sector, and it's all propped up by this idea that the good times will just keep rolling.
Right. So these jobs, they're like a luxury item almost.
Yeah.
Something companies can afford when they're flush with cash, but then when things tighten up.
Exactly. When investors get spooked, rates go up. Those bleep jobs, they're often the first to get cut. We saw it big time, those mass layoffs at Meta, Google, Amazon, and it's starting to spread beyond just tech now, too. Could be a sign that things are like recalibrating, getting more efficient, even if it's painful in the short term.
Right, and even if those jobs weren't exactly essential, each layoff, that's still a person.
Right.
It impacts how much they can spend, what they can afford. That has ripple effects.
Huge ripple effects. And that's the thing, policymakers, they're stuck trying to balance all this, right? On one hand, some signs point to a strong economy. On the other hand, people are losing their jobs. It's a tough spot to be in.
Like trying to solve a Rubik's Cube while riding a roller coaster, as they say. But speaking of policymakers, what should the government's role be in all of this? Should they be stepping in, trying to prevent a recession, or just kind of let it play out?
$1 million question. And the answer, it's never simple. Like we've been talking about, the data's all over the place. That gives the folks in charge a lot of leeway to kind of cherry pick whatever supports what they want to do anyway, especially in an election year like this.
Of course. It's all fun and games until someone loses an economy, right? But seriously, for our listeners who are hearing all this and maybe feeling a little, I don't know, a little panicky, what can they actually do? What should they be doing right now with all this uncertainty?
Honestly, the most important thing is don't panic. Don't let the headlines scare you into making rash decisions.
So no panic selling all your stocks or anything drastic.
Exactly. Remember, investing, it's a marathon, not a sprint. Focus on what you can actually control. For most people, that means get your debt under control, especially that high-interest stuff. Credit cards, personal loans, that should be priority number one.
Especially with interest rates going up, right?
Absolutely. It makes that debt even scarier. And then in terms of investing, you always hear this, but it's true. Make sure you're diversified.
Don't put all your eggs in one basket.
Exactly. A lot of financial advisors will tell you a good starting point is that 60-40 split, stocks and bonds, gives you that balance between, potential growth and some stability too.
And maybe sprinkle a little bit into commodities too, as a hedge against inflation.
Could be a good strategy, but again, always best to talk to a financial advisor, figure out what's best for your situation, your risk tolerance, all that. Can't give specific financial advice here.
Makes sense. So don't panic. Get that debt under control. Diversify those investments.
Got it.
Any final words of wisdom for our listeners before we wrap up?
Something important to remember is that economic cycles are, cyclical.
They're a cycle.
Yeah. Recessions, they're normal. They're not fun, obviously, but they happen, and they don't last forever.
It's easy to forget that when you're in the thick of it, though. What goes down must come up.
Exactly. And often, the best opportunities come from those times when everyone else is freaking out, when things are uncertain.
So while none of us can predict the future or, control the entire economy, just by understanding how this stuff works, by focusing on what we can control, we can make it through to the other side.
Couldn't have said it better myself. Knowledge is power, even, or maybe especially, when it comes to this stuff. Stay curious, stay informed, and most importantly, stay calm.
Such good advice. All right, everyone, that is all the time we have for today's deep dive. We hope you found this helpful, maybe even a little bit reassuring.
Right.
And remember, we're all in this together.
Until next time, keep asking those tough questions. Keep digging for those weird economic clues, and we'll be here to help you make sense of it all.
And hey, if you see a sudden spike in mosquito-controlled trucks in your neighborhood, you know who to call. Just kidding, mostly. Until next time, happy diving.